The appointment of a new cabinet in Turkiye. Mehmet Şimşek is the country's new finance minister, and Hafize Gaye Erkan now heads the central bank. A new team dedicated to do whatever it takes to win the fight against inflation. And these new appointees wasted no time in coming up with an economic action plan. This week, the central bank raised the deposit rate from 8.5% to 15%. This led to Turkey's stock market index, BIST 100, to rally by 4.65%.
As we see from the market reaction, it is also leading to stock market recovery as the main indexes are rising.
The country's annual inflation rate slowed in May for the 7th consecutive month, falling below 40%.
It also means a rather balance between growth and inflation, as Turkey has opted for growth in the past few years.
By raising rates, the hope is to make the cost of borrowing higher, encouraging more people to save.
In order to offset these pressures, first you have to offer an interest rate that is positive enough in real terms to discourage people from consuming, so they will either save, they will put their money in a bank account, or they will think of the loan rate that they get from the banking sector that is high enough to discourage them from getting a loan.
The new finance minister says that these rate hikes are necessary in order to strengthen the lira and stabilize domestic prices for imported goods. Şimşek says that the vision for the century of Turkey involves stability, trust, and sustainability, and that economic policy going forward will aim to achieve these goals. No one knows how long it will take before these policies bring down inflation, but what's certain is the dedication and experience of the people tasked with the mission. Emre Boz, TRT World.
Let's get more on this now with economist and adjunct professor of finance at Boğaziçi University, Taha Arvaz. He joins us now from Sakarya, Turkey. Taha, the market was possibly expecting something a bit different, but the statement in the end alluded to a gradual tightening. What does it mean in practice? What should we expect from now on?
It means further hikes at the next meetings until the central bank achieves what it's looked out to achieve. So I think we see a rapid tightening from here until they're satisfied.
Right, so what sort of peak rate can we expect at this point?
Well, I mean, it's really anyone's guess, but I would be surprised if we didn't see another 10% increase in the next two meetings. And then I think they'll have to wait and see how the markets, how the economy rather, responds. You don't want to overdo it, but you also don't want to underdo it. It's a very delicate balance that's difficult, obviously, to time. Let's put it that way.
What are the effects that we may observe and that we can expect on the Turkish economy as a whole, but especially, first of all, for what concerns inflation in the country?
Right. So there are many factors. It's not just the central bank and its tightening of interest rates that are in play here. We had essentially a managed floating rate of the currency rate for the last couple of years here in Turkey. So as a result, now that the new minister has come in and has abandoned that policy, we've seen a depreciation of the Turkish lira against the US dollar and other currencies. So that will lead to a higher prices for imports, which will hopefully lead to a decreased demand in imports. And with that decreased demand, we hope to slow inflation.
The last GDP print that we saw here in Turkey was actually very positive, especially when compared to the rest of the world right now and Europe. But can we expect any spillover effect on the GDP as well, in your opinion?
So many exporters have been lobbying for a long time here in Turkey for a return to a floating currency rate so that their exports could be more attractive. So that's one of the things they're looking for. Turkey has, after the pandemic, become increasingly competitive with respect to trade with the West, Europe, and the United States. But this currency, Turkey's actual disposable income of the average Turk in Turkey increased by 60% in dollar terms in the last year, which is which is an incredible increase. So when you have so much more money injected into people's pockets, inflation is inevitable. And so with that slowing that increase of disposable income, we should see a slowing of the inflation and ultimately maybe an appreciation of the currency.
Right, Taha, we know Goldman Sachs, for instance, was expecting a bigger hike, potentially to 40%.
Way bigger, right?
Exactly, in one go. And I do wonder, what are the advantages of a gradual rate hike, rather?
So really, what's going on is all these central banks, including the Federal Reserve, Bank of England, ECB, et cetera, are in a guessing game. In 2021, the Federal Reserve predicted a 1% interest rate in the United States in a year's time, and now we're over 5%. So the Federal Reserve was way off by a factor of 90% nearly. So here in Turkey, we also are in a guessing game. But the point is, they don't want to break things while they're going forward. If you increase interest rates too fast, you're going to do irreparable damage to the economy. That's something that they're trying to avoid. Yes, increasing interest rates is important to slow inflation. Is the policy here, but increasing them very quickly, very fast, is a non-starter for this government, it appears, and so we will see a gradual increase from here.
President, last question, Taha. What other measures can be taken outside of monetary policy only?
Right. So Turkey has another tool. The Central Bank of Turkey, or more precisely, the government of Turkey has more tools than its Western counterparts, in that there are many government banks. So the availability for credit to be taken for companies and households to access credit is something that the government can actively influence by using these banks. So if it wants to, it can turn on the faucet, the credit faucet, if you will, and allow for more credit to flow to households and firms. Or conversely, it can slow that flow down. So if it slows the flow down, we will see a de facto hike in the interest rate. We actually have that going on now. So there is both a interest rate increase here that we saw, plus banks are becoming less likely to lend, which is an added increase in the interest rates.